Welcome back, everybody. We got an awesome episode today. Our guest is Jerry Parker, who's back for his third appearance on the show. Listeners can go way back to episode 35 or 452 with Salem Abraham to listen to his first appearances. Jerry is the CEO of Chesapeake Holding Company, started his career in Richard Dennis's turtle trading program. Jerry and I have some big news to discuss. Couldn't be more excited. Jerry, welcome back to the show.
Hey, Meb, thanks for having me. It's good to be here, and I'm glad to be on the show. I always listen and always enjoy.
I'm excited. I know the listeners are excited because having been involved in 15 fund launches, I don't think I've ever received more emails, inquiries, and inbounds than on this fund. So listeners, Jerry and I just teamed up to launch an ETF. And what are we calling it, Jerry? How do you pronounce MFUT, which is the ticker symbol? What are you going with? Because normally, our funds, we have GMOM and we have these other funds and we have acronyms for how we say them. What are we calling it? MFUT? MFUT? What are we doing?
I'm afraid to try to pronounce it. I call it MFUT or Cambria or the Meb Fund. We have different ways.
All right. So this stands for the Cambria Chesapeake Pure Trend ETF, which launched really at the end of May. And listeners who have been longtime followers know that certainly trend following has been at the core and heart of a lot of what we do. But we'd had a trend following managed futures fund filed for probably 10 years. I don't even know, forever. But I said, man, that's a lot of work. It's a lot of headache to trade all these different positions and long and short around the world. So I said, I need the man. I need an expert like Jerry to partner up with. So finally, in 2024, we made it happen.
Well, thank you for that. I mean, yeah, we are too. It's great to partner up with you and certainly to bring to the market an ETF that has many reasons for existing. And that's really, I think, the criteria for me is people going to enjoy this and have a need for it. And I think obviously they do.
I said recently on the show, I think it was the show with Jason Buck and maybe Eric Crittenden. It feels like, quoting Star Wars, it feels like there's been a disturbance in the force. And I want to hear your perspective.
I feel somewhat. Performance has been, 2022 was a great year. We didn't lose too much back last year as an industry. I hear the word trend following a lot, maybe more so than managed futures, which I think is a really good idea. It's kind of what we do. People see the merits of it. They get nervous with all-time highs in the stock market and valuations and maybe more interested in alternatives and real alternatives, not just private equity, a derivative of, once again, stocks. When I started in the industry back in the 80s and in the 80s, 90s, and some of the 2000s, when we would do marketing and presentations, we would show historical performance and how our historical performance of trend following made more than the stock market, than the S&P, and the drawdowns were lower. And so now that we're out of those years of Fed zero interest rate policy and post-2008 government stuff that they were doing, intervention, people now think, well, if rates are allowed to do their thing and we have a little bit of inflation and maybe it seems that that's going to be conducive to better trends.
Let's talk about the strategy behind the fund. One of the cool things when you're talking to a trader like yourself who's been doing it for a long time, it's almost like a Zen mastery sort of discussion, because particularly with trend following, people love to ask very specific questions because there's infinite permutations. Why do you hold 100 stocks, not 150? Why do you use the 10-year and not T-bills? On and on, right? But more than anything, that's true with trend following because there's so many different possible permutations. How does someone settle on an eventual program? Let's talk a little bit about the recipe and the craft behind it.
Well, certainly one of the things that's going to make trend following more successful and deliver something that people are really going to enjoy is just the level of diversification. So for our fund, we may have around 100 markets with almost an equal representation of currencies, commodities, stocks, and interest rate futures. So that's going to give, and long and short.
And listeners, I got to interrupt Jerry because we were joking around in the intro and we were saying for some reason, the powers that be, regulators, compliance, doesn't like saying markets. And so what are we supposed to be saying? Positions? Because market applies to stock market?
Yeah, it can apply to the stock market. I think it's positions, instruments, holdings. So yeah, I did it again. I can't, it's like that game where you're not supposed to say a certain word.
All right, so 100 positions, but how do you settle on 100 and not 20 or not 200?
Well, I start out by saying I'd like to trade as many as possible. And how many do we need to trade? So let's just concentrate on maximizing our diversification and focusing on the more liquid markets. So I think for our fund, it's going to be around 100 instruments and positions and holdings. And so I think that's a good number. It's better than the 10 to 15 or 20 that replicator ETFs like. And so and I think it does matter. You'll get the cocoa in there. You'll get some of the exotic commodities that you may not get with some of the replication funds. So I think, it's good to have as many commodities as possible and have a balanced portfolio. If there's not that many commodities, there's many, many stocks. So you want to get your 25, 30 commodities, and then that kind of dictates how many currencies and interest rates and stocks you're going to trade as well, since you kind of want a balanced portfolio of all those markets and the longs and the shorts.
It somewhat reminds me of being a chef. The reference I make often, my mom's a Southern cook, and when people are learning, yes, you go by recipes and very specific type of instructions. And once you get to a certain point, you can kind of taste it as you go, put your finger in the batter, and understand that, yes, there is very specific quantitative reasons behind everything you do, but also a little bit of humility too. And I think the cocoa is a good example recently, because cocoa, and you can correct me, but historically has not been a particularly trend favorable instrument. Is that true? And so like to have the belief that, hey, we have this philosophy that applies to everything, with the understanding that all markets can have these properties, even though they may have not in the past. Is that accurate?
That's a great way of putting it. I agree with that wholeheartedly. I think that's one of the foundational principles of trend following, turtle trend following, is that all these markets over time, and time could be a long period of time, going to have the same expectation. There are trends in all these markets. Trend following can rehabilitate markets from the dead in the sense that buy and hold, or even they don't do very well, or over the back test, this vaunted back test of 20 or 30 or 40 years. What's the possibility of seeing something you've never seen before in the future? It's a good possibility. So we build the portfolio, number one, not paying attention to historical performance. Now, usually 95% of those markets are going to have decent, good performance, similar performance. But we build it based upon maximizing the diversification. So you do have to suck it up sometimes and say bean oil never had good trends, cocoa never had good trends, and you hold your nose, you put them in there anyways, and you get rewarded. And with this outlier hunting type, letting profits run strategy, the numbers can change dramatically. All of a sudden, you've taken 50 small losses in cocoa, and then you have one of the greatest trends of all time. Now, cocoa, after many, many years of suffering, the numbers look halfway decent or average. So that's all you're looking for. Trend following has a great characteristic in that it does really well when we have it in markets and in situations that we've never seen before. COVID, wars, cocoa, any of those things. That's what we do, because we're dumb enough to follow these rules, get in line with the trend, don't have any expectations, don't look at history in that sense of anticipating the exact events that are going to drive markets. And that usually does really well. And if nothing else, it's really a good diversifier.
I know a lot of the answers to the questions I'm going to ask you, but we have gotten so many from listeners. I'm going to ask some of these because they keep coming up. But, for the people who you already have the trend follower tribe, the people that are already kind of sold on trend or managed futures strategies, and you also have the newbies. So we'll start with the newbies first, and we'll get a lot more wonky and specific. But when you say you trade 100 markets, what are the broad categories and targets?
Around 25 of those markets are going to be commodity related, maybe 30. Maybe we'll overweight the commodities just a tad. They're really diversifying. another 25 or so in the stocks and bonds. People need to have their stocks and bonds wrapped with trend following. They need to have a stop loss. They need a different type of strategy than buy and hold. I don't think trend following is inferior to buy and hold. It's a different way of approaching the traditional markets. We need to be short sometime. There was no safe amount of bonds to be long in 2022. And maybe today as well. It took a breather, but they're still kind of in a downtrend. So I think that you want to have those stocks and bonds in there. They're going to offer profits and diversification and be a little bit different than those traditional markets. And then finally, the currencies, which people usually have almost no exposure to. They're good markets. They have trends. So balanced portfolio, letting those profits run, making some hay on the outliers like cocoa and the yen, the Mexican peso. You've heard that spoken about, I'm sure. So there are these trends. Sometimes you'll get the whole sector moving. Bonds 2022, stocks now, commodities in 20 and 21 after COVID. And sometimes you'll only get this idiosyncratic move, cocoa, coffee now, yen, peso. There's little to choose from now as far as broad sectors. But if you let the profits really go and let them maximize themselves and don't get kind of freaked out by the increase in volatility in cocoa, you can capture some outlier profits as well as the kind of normal CTAs tend to specialize in the broad moves. We're going to do pretty good in the broad moves, sector moves, and in the idiosyncratic moves as well. I would just say cocoa is like, you can make any point you want to make, at least I can, about trend following by using cocoa as an example. So I'm worn it out, but I'm probably going to continue to do it for a while.
Listeners, if you love chocolate, Dandelion chocolate's my favorite. So we need to reach out to Dandelion, see if we can get a code or something, Colby, we can pass along, but best chocolate out there. So I was thinking back when you were talking, because maybe 2022 was really the wake-up moment for investors thinking about managed futures, because nothing helped in the very traditional sense of markets in 2022 other than really trend. And trend, one of the reasons that helped so much is because it was short bonds. And there's no other strategy that would have been short bonds in 2022 other than perhaps a discretionary macro or maybe a long short manager that was really leaning into the shorts and other things, but certainly not private equity, which is increasingly becoming the savior that all institutions are looking to, and private credit as well. But listeners, the cool thing, people are always talking about what they hold and like to brag. And I said, now you can talk about, you're at a cocktail party, you can say, hey, look, I'm long platinum, short soybeans, hogs. No one else is out there talking about being short hogs, but that's a pretty eclectic portfolio that it's going to be differentiated versus your pure NVIDIA and megas. Hopefully, not always, not guaranteed, of course, but most of the time when things are hitting the fan, these things tend to have done well. If you look at the SocGen trend index going back for a few decades, or BTOP or Mount Lucas, all the various publications. We'll put some links in the show note, listeners, for some of the strategies there. Probably the number one question we get from people, in addition to how many markets are you trading, what are you trading, is how do you decide how much? And this is usually coupled with, what's your volatility target? We've received that question probably 30 times. So how do you answer that question?
Well, on a per market basis, if you're asking that, all of our trades are kind of have the same risk across the board. If it's the sectors, like I said, it's roughly 25% each, those four sectors. But on a trade by trade basis, like most CTAs, they do it inversely to the volatility. So if a market's highly volatile, like Bitcoin, which I think we do have Bitcoin in the portfolio, Bitcoin futures, that's highly volatile, silver, highly volatile. We trade smaller positions. Some of the short-term interest rates, which have very little volatility on a daily basis, those positions will be larger. We want each one of our positions to have sort of the same possibility for contributing to the portfolio. And so some markets, like the currencies and interest rates, they really don't move a great deal if you measure the volatility in a traditional way. So we have to trade those larger. And of course, some of the stocks and commodities, we trade them a little bit smaller because the volatility is higher. So this is sort of a typical approach from all the CTAs to make those, I hate to use this word, bets, similar bets. We want to bet the same amount on all these different positions and markets, holdings and trades. So we get equal contribution. At least we're set up to have potential similar contribution from each market. Same risk, as much as we can control the same contribution.
So when we look at kind of the landscape of managed futures, and this happens with a lot of our business as well, should I buy this fund, that fund? What do you see as kind of the main differentiators? The one thing that we have yet to mention is this fund is 75 basis points. So that makes it one of the lower cost expense ratio for managed futures, public funds as well as private. But there's been a trend towards things like replicators and other ideas. Why did you end up with this strategy, and what are the main differences, positive and negative, versus what else is out there?
I think, the fee thing, it's really, really a great idea. We've got a lot of positive feedback and some consternation from some of our competitors as relates to the fee structure. So good job on that. Broad way of looking at this too, from a Chesapeake point of view, this is our best product that we could offer. We can't do better than this. Everything that's in my head for 40 years, I started in 83, is in this fund. This is not our version of a watered down product. A lot of the other CTA ETFs, the managers have a hedge fund product with a performance fee, so they can't really give this away in an ETF format. So they have to, on purpose, make it a little bit worse, fewer markets, maybe not their prime approach to preserve and not cannibalize their really the products that make them all the money. So from a Chesapeake point of view, this is all we do, manage these ETFs. We put our best ideas out there. We love the trend following, we love the diversification, but we're heavily invested in all of these funds. This is really all that we do. So I think that's a benefit to this fund. We trade this single stocks for our 25% allocation to stocks, long and short. We're going to get a better diversification rather than using the indices. Right now, there are no short indices. They're all long, all around the world, 20, 30 indices. We have some shorts. We can do shorts because we're looking at individual stocks, and some of them they're not all in an uptrend now. And we're going to have a better possibility of getting an outlier trade from a group of single individual stocks versus an average that's going to be kind of weighed down by the other stocks that are in there. No CTA would ever trade the dollar index and not trade all the wonderful various currencies that we too trade. No CTA would ever trade a commodity index. No, they want to trade the grains, the metals, the energy, the softs, cocoa. And so we feel the same way about all of those and the stocks as well. This fund is probably one of the few, if not the only one, that, like I said earlier, lets profits run. It's going to be bumpier. It's going to have some volatility. Cocoa is just a hell of a situation with this volatility. It's a small trade. It's small, 1 out of 100 holdings. But really, you're going to get those blowout profits by letting them run and not being so eager to take some profit off the table when the volatility heats up. So that's a controversial difference, but a real traditional, classical, pure trend way of trading. And I think, in my opinion, a welcome difference versus most of the other ones.
When you guys heard Jerry reference the phrase, let your profits run, that's a reference to a quote that is from David Ricardo in the 17 or 1800s when he lived. And it's the cut short your losses and let your profits run on, which you got a few centuries in there. But there's been a few good pieces on kind of the history of trend following out there. We were noodling about the idea about putting together a little documentary. We have a friend who does some of these that end up looking pretty good and uses a little bit of AI in there. So we may have to get something in the works here this summer if we can get around to it. But that's a great way to concisely convey much of the philosophy in just one little quote.
I love that. I don't know if you've seen the Dimensional Fund Advisors documentary. It just came out. And they used, I think, a famous director. I watched the trailer and I thought, man, that's almost enough, a trend following like trailer documentary. But yeah, it would be great to sort of see something like that. I think people would love it. I know I loved watching the DFA. I've always liked that firm, the exact opposite of what we do, but they have a lot of true believers, and so do we.
Cool. We'll put the link in the show notes, listeners. Tune Out the Noise is the name of the film. So stay tuned. Maybe we'll get some producer credits to our resume this summer as a new thing to add in our career.
Well, I was in a movie once.
What movie?
You're going to think this is not true, but it is true. And I had a SAG card, and I'm in the movie database. It was Me, Myself, and Irene with Jim Carrey. And so I had a few lines with Jim Carrey.
I mean, like, how did that even come about? You're just like, you know what, this trend following, I can just put it on computer, put it on autopilot. I'm going to go see what I can do in Hollywood.
Yeah, exactly. I was in 2 episodes of Spin City with Michael J. Fox as well. And it was a Robin Hood Foundation dinner in New York. It was an auction item. And I bid on the auction. Yeah. And so they used to do things like that. And my family and I had dinner with Gwyneth Paltrow. So it was just an amazing thing. I couldn't turn it down.
That's funny. Colby, let's find Jerry's clips and we'll put them in the show note links and people can watch his storied acting career. That's awesome.
Exactly. Yep.
And by the way, listeners, for obvious and full disclosure, the beauty and benefit of an ETF is the holdings are updated daily. By the time this publishes, in between the time we've recorded it, positions, of course, can and will change, but you can always see them and download them on the website. So if we're talking about cocoa being up or down, who knows? Bitcoin, stocks, obviously these positions will move. But when you talk about trend, that means a lot of different things to a lot of different people. How do you kind of describe it to the people who have a little bit of knowledge of trend following, but want a little more understanding of the mechanics of what you're targeting?
I do it easily because I've had this question for many, many years. I think one place to start is how long do you hold the average trade? And we'll tend to hold a trade for a year on average. So we're not in and out. We're trying to play for these big moves that can take 2 years. We get out of the losing trades quicker, of course. Attempt to take those small losses, and we usually succeed at that. So on average, if you pull up a chart and you look at some of these secular moves in all the markets, they tend to last a year plus. So we want to capture those and not get out too quickly. We're always walking that fine line. This is the job that we have, and that is stay in the gear with the big trend. Don't get bounced out and whipsawed in and out. There was a big trend. Why didn't you make money? Because I kept getting in and out. Okay, we don't want that to occur. But then we don't want to be pigs and stay in too long and once the market does turn around, we give back too much of our profits. So we have to look at the research and the back testing and analyze what's going on and what has gone on for 40, 50 years in the markets. We like to look at a lot of data, just not recent data. We don't want to overweight recent data. All the things that human beings think, well, that must work if you just overweight it or you just use the last few years. So we don't think that works either. We have to have a large sample size of trades to look at, discrete, independent trades. That's what we're interested in. So it's good to be kind of like a chart person and look at the charts and just describe your way of trading as, oh, this is trend following. These trends are up. These trends are down. Looks like the trend has reversed a bit. These are all words. They conflict with numbers. We have to look at the numbers first and see, okay, what has worked in the markets? And what has worked is this longer term approach, at least 100 days and on up to uncomfortably large numbers, average holding period of a year, volatility, potential givebacks that are certainly uncomfortable, and maybe that's why it works. But we really have to get those numbers from the computer and say, this is how we're going to trade, because this is what's worked best. And then when trying to describe this is more an art and less precise, because sometimes people will say, well, look, it doesn't look like that market is still in an uptrend. And I'm like, yeah, it doesn't, does it? But we're following the rules that were derived from the numbers, from the back test. And sometimes it doesn't look like we should still be in it. But that's something we need to try to avoid it as much as possible. Although I look at hundreds of charts every day where the actual trades are done using specific rules derived from backtest.
When I wrote a paper during the pandemic, I don't know if many people read this one, but it was called, Is Investing at All-Time Highs a Good Idea? No, it's a great idea. And we kind of looked at very simply, what if you just bought a number of these markets when they were at all-time highs? And it turned out it was a fantastic idea. And Jerry just very quietly whispered in my ear, maybe it was a Twitter DM, maybe it was a response, maybe it was an email, I don't remember. But he's like, hey, maybe if you shorten the look back to just 12 months or something like that, this might work better. And then we, of course, put those stats in the paper, and indeed, they worked much better. But the point being is that so many investors, as markets hit all-time highs or hit regional, local highs, you have a quote, and I forget what it is, but it's about being fearful. People struggle with that concept, particularly the ones that it's a stock or an investment that's done well, that emotion of not wanting that to go away. They really struggle with things when they're at all-time highs, but it turns out it's not a scary place to be. It's actually a warm, fuzzy place to be most of the time. Caveat, and the big asterisk of my paper that I think was very overlooked, and then when the media picks it up is overlooked, is there's an exit. So there was, I forget what we used in the paper, a 10 percentage point down or something where you got out, right? So it wasn't just the all-time highs. There was that you had a parachute too, which really I think made all the difference in the world for that type of strategy, is that you just can't hold it forever. Otherwise, you're going to have a 80% drawdown probably one day in your future.
Right. I mean, the quote I think you were talking about is that when people have losses in a trade, they have a tendency to be hopeful that it's going to come back. They don't want to book that loss, and they should be fearful instead, because the loss could get larger. And when they have profits, they're fearful that the profits are going to go away because they've already spent that money in their head, and they love that big, huge profit. They should be hopeful instead that it's going to keep getting larger. It's almost like when you do these back tests, the computer knows personalities. The market data historically has been impacted by bad trading and a little bit of good trading. And it's basically showing you're not tough enough. You don't want to know the answer to how long term you need to be and how bold you need to be and tough you need to be with profitable trades. You don't want to know. You can't be that good. You can't be that tough. And that really is the hardest thing for everybody, is to hold on to those winning trades. Even follow your own rules. I think it's tough. If you've got good rules, then you've got to follow them. So that second part is usually really hard. And you try to come up with other rules. I think the evolving over the years of trend following has been, let's don't be discretionary. Let's just add in some discretionary rules. We can say we have rules, but they're kind of discretionary rules because the sample size is low, because they're trying to exit these profits, these mega profits, where there's very few of them. So by definition, there's not much to look at in a way that doesn't give back too much. But it's almost like if you're willing to give it back and follow your rules that you've derived from the back test that says, hey, this is the way to go, you're going to be in great shape. If you're willing to do that, you're going to really put yourself in a good situation. But it's really psychologically difficult. And once again, I think that's why trend kind of works. People don't like taking losses. They don't like having a win percentage of 40%. I mean, certainly everyone, you got to have a 51% win percentage, right? No, people don't like big profits turning into small profits. They really don't like big profits turning into small profits. One of the worst ideas ever from a back testing and a data analysis point of view is let's set the stop to break even. So now that we have this profit, let's set the stop to break even. I mean, that's coming directly from our emotions, right? Which we know is wrong. And the computer will say, oh, no. That was that nice profit that you had that's all gone away. You've got to give it a full loss. Embrace this pain and suffering. And I think this is what our rules attempt to do. We created a rule one time that said, try to buy the high of the day. And this is just something that traders just despise. They could be making all kinds of money during the day. And if you get a bad fill back, why did I buy the high of the day? This is just like so irrelevant and trivial, but they would really focus on that. So we said, okay, given that people don't like that, let's try to do it on purpose. And of course, you can't really do it because sometimes you're buying the high of the day, but then it keeps going up that day. And basically that added a few percentage points to our average trade.
Back in our younger days when I was testing a lot of kind of stat arb and other trading ideas, listeners, if you want an almost near guaranteed 100% trading strategy for batting average, so Hall of Fame as far as percentages is you buy a security, whatever it may be, and your exit is first profitable close. That may come the day you bought it, may come the next day. And so you're almost guaranteed to make money. The problem, of course, you very quickly see is that you get giant losers, because if something goes down and never comes back, you may end up holding this position. Your probably median holding position is like 3 days, but your mean length is probably like a year or two, because you get a bunch of these securities that just never return. And so the search for comfort and certainty on profitable trades can be misleading and dangerous, as long as you don't account for the size of the winners relative to the size of the losers. So, but it's fun to go down that rabbit hole, because once you start to test it, you get an understanding of how much that matters. And look, I think if anything I've come to learn over the past 20 years, it's been power laws really dominate everything. We had a podcast with Bessenbinder who talks about this with stocks. It's like 5% of stocks generate all the returns over time. And trend followers, that's music to our ears. They've known that for a long time.
One of Rich's things when we first got there in 1983 was to say that his research was based upon cliches, proving trading cliches, investing cliches wrong. And one of the first ones we heard about was you can go broke taking a profit. So for a trend follower who's going to build up 60% of those trades being small losers, you really have to maximize those infrequent big profits.
Listeners will know, I've said this a few times, I tend to repeat myself when I find something particularly useful or insightful, but the late, great Peter Bernstein had a quote that I just keep quoting, and it's roughly, he's like, a asset allocation strategy is great because it's defensive, but also because it's offensive, because you never know where the next great gain will come from. And I'm paraphrasing, I just murdered the quote, but it's the same with trend following. You're trading 100 markets. I guarantee you, if you and I sat down having a coffee or drinking some champagne on New Year's Eve at the beginning of this year, and we're like, all right, Jerry, let's predict. What do you think is going to be the best performing market? No idea. We have our guesses, and often I'm like, I have my hunches, but the chances of being right is probably slim.
I love your daily quotes, and I like to be the first person to like them. They're always really good. I know Rich was interviewed once. They asked him, what do you think are the best markets or the best trades? And so I was really interested in hearing this answer. And he basically just went down his portfolio. He was long some and short some based upon the trends. So that's all we have really is the trends. I do think another thing that helps trend following a little bit, we built it into our systems just slightly, and that is don't shy away from markets that have been really bad. They haven't had a trend in years, multiple losers in a row, very frustrating. People hate the market. They've written it off. It's not trending any longer. I've lost money 5 times in a row. I'm going to write that off. You got to really be ready for that, because that's really, that's another perversion, because at some point in time, you're like, really? Now it's been 10 in a row. But it really is building expectation, the more pain and suffering you've experienced in a market. And then likewise, when you have these V tops and V bottoms, people are like, oh, wow, I'll make it on the way up. Now I want to make it on the way down. And that usually doesn't work out that way. So you're usually in for some sort of consolidation and the building of the base, many losing trades in a row. So to some degree, you pay attention to, I think that works as well.
One of the differences in this fund relative to a bunch of others, you got to do something with the collateral when you do these type of strategies. And one of the partnership concepts is, T-bills is sort of the default. And we published a paper earlier this year called T-bills and chill most of the time that really talks about the fixed income space and how to think about it with the various spreads out there. So the collateral can take on a little more duration depending on how fat the spreads are, which as of summertime, June, they're not. The fixed income space is an odd place right now where many of these spreads are negative. Everyone's been talking about the inverted yield curve and all sorts of other things like that. But one of the benefits of a managed futures style exposure versus 5 years ago is the collateral gets you something. For a long time, the collateral was zero because T-bills yielded virtually nothing. But now that's up to about 5%. And I have a non-consensus view, I think. Maybe it is, who knows? Or maybe it's just too nerdy to even talk about, but people love to talk about managed futures and just how much of the return comes from collateral. over time. But I think that's true for every asset class. That inflation component, the collateral component, applies to just about any strategy, including long short and other markets. But that's a rabbit hole we probably don't need to go down today. We kind of glossed over a little bit of a position sizing and thinking about trend in a portfolio. We've often are the outlier here as far as RIAs in the country and say that 50% is our default, which is higher than I believe anyone I've ever spoken to that's not a pure trend asset manager. But as far as an allocation, how do you think about it when you talk to people about allocating to trend funds? Do you even venture there? Do you talk about it? And then we skipped over the replicators a little bit. Do you think they're complementary?
I'm 100% trend following for my personal. I think it's good to make sure people understand, look, you're having your stocks and bonds. Now, one of the benefits is sometimes that it's going to be better to be short. But I want to have that stop loss. I want to have the trailing stop. I want to have a rule that gets me back in if I happen to get out. But I don't, and I think trend following is equal to or greater than buy and hold. So you're not missing out. You're still getting those things, those core traditional assets. But from my point of view, a much safer, better way of handling it. But even when given the opportunity to, in real life, talk to my friends or family, and they say, should I do 100%? I'm like, no. I don't want to hear you complaining. Like, do your stocks, do your bonds that are free, and then add a little bit of Chesapeake, MFUT. But do I really want to be on the hook and convince you to do 100% like me or 50%? Personally, it's not my job. It's your job and other people's, but I'm just managing and I take care of my own stuff. But I do think that people lose sense of you are getting great stocks, you are getting great bonds, and you were short bonds when it was right. And one of these days, it will be right to short stocks as well. And you just can't get away from that fact that that's the Kool-Aid we've all drank. You really don't want to talk bad about the possibility of stocks going down and that 60 or 50 or whatever it is on that first line actually being a problem because it hasn't been a problem. But I think at some point, clients are going to say, who was out there telling me that this 50+% drawdown could ever happen again? One of these days, they're going to be saying, who actually even mentioned that? And we want to be able to say, well, we kind of did talk about it, and we did give you some good alternatives.
I always talk to people when I'm talking to investors, they stress out so much on should I buy this or that? Doesn't matter what it is. It could be an asset class like gold. It could be a fund, a specific strategy. And I often tell them, I was like, look, once you've done your homework, have a little self-care and kindness and don't stress about it. If it's a position that you're like pulling your hair out about that you can't decide on, like just sell half or dollar cost in or out. Or if it's an asset class, I'm of the belief, something like managed futures, you can own multiple funds. And I think that's totally fine. And listeners can see, again, we manage a bunch of allocation strategies. You can look them up online and see all the various funds we own every day. And to me, it gives a little bit of a diversification comfort. Now, again, I think it's important to do the research. So you ideally don't want to be buying poorly designed funds or strategies, but it's totally okay to own a handful of them with the asterisk caveat star that the whole point is not to buy 4 and in 1 year sell the 3 that did the worst, right? Like that's the exact opposite way to do it. So many people do this consistently, chasing performance. There's so much academic research on it that shows that people love to chase the winners and sell the losers, when in reality, you should probably just be rebalancing them. So once they've met the criteria, I think it's okay to have a handful of them. And my time horizon is probably 10 years. I don't even think you could come up with really particularly much information that's useful under that period. We had Ken French on the podcast. He said 64 years, but you don't have to wait till, I can't even do the public math. What would that be? 2088 for when we would know if MFUT it was a success or not. So we'll stick with 2034. You guys can check in and we'll do this again on holograms. But I put the replicators in that category too. Ideally, in my mind, and we've written about replication strategies, not just in this, but other topics, but I think nothing's better than the original. These aren't 2 and 20 funds like some of the hedge fund world, where replication to me makes a lot more sense because you're avoiding that giant carry cost But as a strategy that's 75 basis points, you don't have that, which I think makes it pretty interesting. But they all do it a little different. So do your homework, read the prospectus, listeners. Looking back at history, and you talk about your trend friends and allocation friends, who's Jerry's trend Mount Rushmore? You can't put yourself on it. I'll put you on it. Let's say you're off to the side. You're Crazy Horse, maybe, the next monument over. But you got to go trend following Mount Rushmore. Who are some of the names you'd put up there? Is Ricardo up there?
I would have to I would want to stick to my contemporary peers since I've been in the business. I mean, John Henry is definitely up there. I think a friend told me a long time ago, the best indication of reliability is just a long-term track record. So, you got people who have been around a long time, Dunn and Campbell. John Henry was around for a long time. I'm leaving people out. I think many CTAs that have gone through the battles, people change their strategy. They go from shorter term to longer term. That's definitely happened with CTAs. 25 markets in 1983 to 100 markets in 2024. And this happens with everyone. So you're not really buying the system and the strategy, a strategy that has not changed. It's changed dramatically. And people have evolved. It's still trend. It's still diversification, longs and shorts. Always been currencies, commodities, stocks, interest rates. But what you see in this long-term track record is this individual firm's ability to survive and to take those small losses and to use the good money management that's inherent with trend following. Being a little outlandish here, but I've said this many times. Diversified CTAs, almost any of them, they don't really have the ability to have a performance as bad as the S&P. 8% or so with a 50+% drawdown or something like that. And how could we? Because we trade all the different sectors, not just stocks, and we have shorts, and we take small losses and go with the trends. We don't have big losses on trades. If I only traded the interest rates, that would have maybe similar or maybe worse. If I only traded the commodities, no matter how wonderful I think they are, maybe they'd make 8% with a 50% drawdown. So the mere fact that stocks compete only being in this one sector, it's just remarkable that people can hang in there with such pitiful performance. But we get held to such a higher standard because we're weird. We trade commodities and hogs and shorts. I have no idea what that is. These systems, I have no idea what a trend following system is. How can you make money not using fundamental information? And these chart patterns just doesn't make sense. So we come into this game, we step on the field every day with a big unfair advantage with all this risk control and diversification.
I definitely have a soft spot for a lot of the more traditional, not solo operators, but people that have been doing it for decades, like yourself. You mentioned a few others done in that category. There's a good resource, listeners. RCM has a great database. If you go to RCM Alternatives, we'll put it in the show note links, where they track a lot of the traditional firms. You have a lot of the big institutional quants, and look, we're good friends and love those groups too, like PIMCO and AQR and MAN and all those others. But there's definitely a soft spot in my heart for the ones that have been doing it for a long time, because they tend to be pretty unique and, like you said, not as much where it's just now a vol condensed, watered down version of the trend kind of strategy. But it's fun to read about some of these old stories from back in the day. Michael Covell's book is a good start for a lot of listeners, trend following, if you haven't read it as well. Because there's a lot of personalities, just like in the hedge fund world, a lot of personalities in this space that have come to it from a lot of different directions. What's Jerry thinking about? What's on your mind as you look out to the horizon? You're always trying new ideas, working on stuff. Anything you're excited about, confused about, in between?
I know what's on the top of my agenda. I don't know can't think of what number 2 and 3 is, but number 1 is I really honestly have come to this conclusion because we just finished making the corporate decision to shut down our private hedge funds and embrace being an ETF manager. I think we're at the beginning of these ETFs, and these are these incredible products and structures that people love. And there's many reasons to love them. And I think we're going to see a major, major move, especially with CTAs, into these ETFs. I think a lot of them are in denial that this is happening, and it's tough to give up that performance fee. But I think this is what I see as something very exciting And something, whenever I come to these conclusions, like, okay, let's fully embrace being an ETF manager and let's the flat fee, et cetera. But the first thing I think of is, why didn't I do this like 5 years ago? Because I think the writing has been on the wall. It's speeding up. And as you said earlier, trend following seems to be regaining its momentum and speed, but so is trend following in the ETF wrapper. And I think people in the ETF business, you and Wes and others, have been kind of saying this, and we've not wanted to hear it as an industry. But I do think that this is the next wave we're going to have lots of competition in the future. We have to stay on top of our game, make it better for clients. This is the American way. Things get better for the client and they get cheaper. And this is what this revolution is coming in alternatives, and especially for managed futures. I don't know if you saw this paper that Katie Kaminsky put out with a colleague from Alpha Simplex, but it was an amazing paper. I tweeted the hell out of it. 95% of the assets under management in managed futures is from institutions. So there's been no penetration for really to speak of. And so the sky's the limit on what can happen with the CTA, our fund, and all the other CTA trend following funds out there as it relates to the potential to get these advisors' portfolios where they need to be with the proper amount of trend that makes them comfortable. She also said that the performance, institutions were buying ETFs. We're going to get it whether we like it or not. They want to buy it. It's so easy. It's anonymous. I think anonymity is a big thing. I don't want to hear from you. I don't want to know you bought it. I definitely don't want to know when you sold it. You're not happy, whatever. And I think clients are the same way. I really don't want to call up Jerry and say, hey, you suck. I just want to sell it. And so I don't like that. They don't like it. Some of us have that kind of personality. And then she also said in this paper that the performance of these CTA trend following ETFs and mutual funds are starting to look very similar to the institutional product with the performance fee. So I think this is the problem. Trend following, many papers have stated, trend following is just too powerful to not be the primary source of profits from CTAs who add other things to trend following to try to have some distinction and justify a performance fee. But the trend following is it's too much.
We'll add that link in the show notes. That was a great paper. Former podcast alum. She's wonderful. One of the things has really been my talking point of the summer was a paper we put out called The Bear Market and Diversification. And it was kind of just looking at, hey, the S&P just steamrolling everything since 2009. It's done 15% compounded, which is pretty astonishing. Amazing for all the equity holders out there. Congrats. At some point, that ends. Could be this year, could be next year, could be 2028, who knows? But at some point that ends. And I think if and when that happens, certainly strategies like managed futures, MFUT, I think that the adoption becomes much more widespread when this regime eventually sort of peters out. But again, the timing, in the meantime, we'll own it. We'll own the things going up as long as they're trending in that direction. And it's fun to watch, man. We did a tweet earlier in the year on the NVIDIA. By the time this publishes, listeners who know it might be a $5 trillion company, but which was going to happen first, Bitcoin 100,000 or NVIDIA 3 trillion? And I think it's like 3.2 trillion now. So we might have to redo that poll and say 5 trillion there or something else. I don't know what. Cocoa quadrupling, maybe, who knows? Jerry, this has been a blast as always. People want to find more information, certainly on the fund. They can go to CambriaFunds.com, www.CambriaFunds.com. But when you want to find more on you, other than our soon-to-be-released documentary that I'm excited about, what's the best place?
ChesapeakeCapital.com. But really, I'm very active on Twitter, and I love interaction on Twitter. RJPJR12.
It's been a blast. Thanks so much for joining today, and good investing, Jerry. Thank you.
Thank you.